Cool.
What's the big deal with 3.5 times GDP in terms of debt? Welcome to News of the Money World. I'm Darcy Ongaro, and this is Rupert Carline. How are you, everybody? Welcome. Thank you for joining us. Rupert, how's your day today? All good?
It was great. Well, actually, no. I had a bike stolen yet again. Third bike I've had stolen. Yeah.
Wow.
I just don't. Yeah. So not great, but I will get over it.
Yeah, well, you won't get over it riding a bike. That's too bad. Maybe we should start give a little page for Rupert's constantly stolen bicycle fund, something like that, right?
Yeah. This lock was better than last one, so I don't know. It's the mean streets of Auckland only getting meaner.
Yeah, there's probably some truth to that. Cool. Well, speaking of mean streets, we're living in a mean world right now where it feels like money is being fiddled with a little bit. So I thought maybe we could have a conversation around money supply. What does that mean? Is there any way back from here? And what we're talking about loosely is that for the past 30 to 40 years, money has been created a lot more, and it's creating or has created a lot of distortions. And that's complicating financial markets a lot right now, isn't it? And it's making things hard to read, and it's possibly at the end of its tether in some ways. So I don't know how to maybe start this conversation with you, but maybe in terms of the level of quantitative easing that we saw probably really picking up maybe 15 years ago in particular, what has that done to the global economy? Rupert, do you want to start there?
Yeah, so what we've really seen over the last kind of the better part of the last 30, 40 years is just this huge increase in debt supply. And what that means is it means lots and lots of money has been going into the broader economy. And what's really unusual is that we've been seeing debt grow at kind of 2 to 3 times faster than the broader economy. Typically, money supply grows in line with the economy because fundamentally, if the economy is only growing at a certain rate, why do we need to keep on creating more money? And how have we done that? We've done it through leverage. Huge amount of leverage, so global leverage has grown from about 1 to 1.5 times GDP, all the way up to 3.5 times GDP over the last kind of better part of those last 30 years. So a really interesting time. And I kind of if I'm smart enough, I'll figure out how to share the screen. And I can show this quite cool chart, which just shows where it's all just taken off over the last 20 years.
Okay.
So here, for those that can see, we can see that kind of if we were to put everything, so you base everything at 100 back in 1996, you can see that the GDP, so the world economy, was now at 228. So the world economy has grown at 2.28 times, whereas money supply is now at 616. So kind of grown at 6 times that same amount, and a really scary divergence. And unfortunately, for those that are looking at the screen, where you can see is that divergence really took off in March.
We can't see the screen. Unfortunately, for those that are watching, we can't see the screen there. It's a little bit of a technical issue with that file, unfortunately. But we'll believe that what you're saying is true.
Well, but anyway, so what you can see is that it was actually 2008 where the growth really accelerated. And because that's that period of low interest rates and quantitative easing, which most of the world's central banks have been toying around with for the better part of the last 15 years as well. So really interesting times. And it's kind of fascinating to see how much leverage is built up in that global economy.
And how do we get this far? Because I'm guessing that there's a possibility that this was a policy idea, just trying to follow that consumption-led model of economics, where if you give people a loaded gun, they'll use it, and that will create the consumption that we need to grow the economy. But also there's probably this element that it's easier as well, right? Like it's easier probably to get out of trouble basically by printing money. Is there an element of that?
Yeah, so look, there's 3 or 4 things, but printing money has got to be one of the biggest ones, right? So I mean, quantitative easing was something which I found, which was really interesting when you get into the history of it. So quantitative easing was initially introduced by the Japanese central bank back in the late 1990s, early 2000s, following kind of their crash. again, it was an economy that was struggling to deliver growth, struggling to kind of come out of that recession. And so come 2008, 2009, when central banks were trying to figure out a way to help their economies and help them recover through the global financial crisis and after it, they kind of went, oh, hold on a sec. There's this really innovative new piece of kind of financial engineering that we can have a look at out of Japan, and that was quantitative. What's really interesting, unfortunately, we always look at these things in the midst of a crisis, and when you're in a crisis, you don't really think that clearly. You just look for the quick and easy answers and trying to do lots of things that make an impact. And to be fair, quantitative easing was that answer. Keeping interest rates ultra low across the entire curve meant that huge amounts of money got pumped into the economy. And unfortunately, no one really thought about, well, what are the long-term implications of this and how do we get out of this situation? And to be fair, it's kind of really interesting. I was listening to a great podcast the other night talking to an economics professor at Stanford. And for them, he was talking about back in 2008, there was no research on getting into QE because it hadn't really been done. And today, everyone's saying, well, what's the path out of QE look like? And again, the answer is, well, we've got no idea because no one's ever done this before and we've never really thought we would. So who knows? So quantitative easing was definitely a big one. The other two things that can't really be overlooked, and this is why it's probably more than just a 15-year story, and definitely probably a 30-year story as well. There have been two big shifts in the broader economy. One is the emergence of kind of pension funds, really, superannuation funds. So if you think about the New Zealand economy, for example, what we've got is we've got NZ Super, we've got KiwiSaver, ACC. All of these are big entities with huge amounts of savings that then need to go and be reinvested. And this has happened all over the world. So you've got a lot of money that's kind of been stored today that's been expected to be spent in the future. And one of the ways that people earn a return on that money is by lending it. And so kind of that creates leverage. Plus then you get into kind of the very sophisticated financial engineering that's been going on into this world. Which has been a bit of a mechanic that creates leverage upon leverage upon leverage upon leverage upon leverage, which is what you saw in the crypto world in May, and that came to a pretty spectacular crash back then. It's kind of created this whole new paradigm in this whole new world. But to my mind, it's those three things that have really done a great job at kind of coming together to create the highly levered world that we now live in.
That's great. So if I can remember what you just said, quantitative easing, complex financial engineering, and the pension one though, can you just go back and explain the mechanics of what you just said before, where the money is kind of stored up and then that inevitably leads to leverage? Can you just go over that part again?
Yeah. So one of the things that's kind of newish in the world economy, and by newish, I mean over the last 30, 40 years, historically people have spent what they've had, right? And so you spend what you've got and you end up there's been very, very little thought given to long-term savings. But now what you've got is you've got more and more and more entities which are being set up to save. And so that means pension funds, that means KiwiSaver funds, sovereign wealth funds, etc. And actually what's really interesting about a lot of these funds is kind of a significant chunk of the money that they have invested, they're lending out to other parties as well. So what that does is a great source of funding, which can then be used to leverage. And because particularly in the last 15 years where we've had very low interest rates, they've needed to earn a supernormal return on that leverage. So therefore they use leverage upon leverage upon leverage. I think that pension fund and dynamic has created a huge amount more available leverage in the market. Does that make sense?
Yes, it's like a larger pool of capital that could be drawn upon to form the basis of extra lending that can get created out of thin air, right? And so you're building a pyramid scheme.
Yeah, hard out. And basically, when you go when back in 2007, this was one of the big issues in the residential mortgage space, is a piece of a mortgage might be kind of lent on kind of, it was one piece of lending, but then there was lending funding that lending, and there was lending. So you might have 5, 6, 7 layers of lending before you actually end up at the end mortgage. And then kind of, and every time there might, and back then it was even worse, you might even have the same pension fund lending 3 or 4 times and getting into it. Plus then you've got some central banks in there. Yeah, it's just we've created this kind of this virtual cycle of money that keeps on creating itself, really.
Yeah, and eventually the head of the snake will eat itself. I'm guessing. Who knows? Like thinking about the crypto thing, right? Like one of the best quotes I think I learned early on this year was that every generation invents its own Ponzi scheme to replace the previous generation's Ponzi scheme. It's just that granddad and grandma's Ponzi scheme is just quite spectacular. And I kind of worry, if that does unwind, what does that look like? But maybe if we went to what kind of damage it's caused so far, where can we see the symptoms of the over leverage right now? Where is that starting to show up in the system?
Well, I think what has this created, right? So the 3 or 4 big things that we spend a lot of time talking about. One is this phenomenon of zombie companies, really. So companies that don't really earn a decent return on capital, a decent return on assets, and fundamentally, these companies have been able to survive because they kind of just can keep on refinancing their debt at cheap rates, right? So you keep on refinancing your debt at 5, 6, 7%. Kind of in historical terms, not many companies would have been happy about that as a return on capital. And the basis of zombie companies is actually really bad for a broader economy. We've talked about this quite a bit in the past. Capitalism relies on the destructive element of capitalism. And so what I mean by that is you need companies to fail so that the bad companies fail, the good companies prosper, and you kind of keep on evolving. That's how we get productivity growth. That's how we keep on kind of evolving on the way through. Whereas over the last 40 years, there have been companies which have just really thrived on 2 things: cheap money and cheap labor. Sorry, back to my other bugbear, cheap labor. And I think that's we're starting to see that potentially unwind, or maybe we won't, but that's kind of definitely been one of the big outcomes. Second big outcome that we see is over the last 15 years, governments have even given up the pretense of trying to kind of keep their economies and keep their spending in check, right? New Zealanders, as much as we love to moan about the New Zealand economy and New Zealand government, we have probably got one of the most fiscally conservative governments in the world. And it's kind of fascinating where you kind of look at all of the other big global economies apart from China. They all run deficits. They all plan to keep on running deficits, and kind of no one really has any idea how they're ever going to get back into surplus. And we've seen these government balance sheets absolutely go nuts. And then the third big thing that kind of what's driven this, what's kind of also there is going where you massive asset inflation, because as kind of we've kept interest rates low, the interest rates have driven kind of the value of assets all the way up, because the opportunity cost has meant that the cost of capital has come right down. And what's that done? That's meant that we've now got a more unequal society than we've had for the better part of the last 100 years. I think kind of you look at signs of inequality, we're back to kind of pre-World War I levels, and kind of an area where we haven't kind of, which is interesting, right? Because the global economy went through probably the better part of almost 80 years of kind of inequality reducing. And now we're heading back the other way, which is kind of fascinating. Over the last 20 years, we've seen that increase. So kind of those are really the big 3 outcomes of this kind of what I call the debt binge and where it's got to. I guess the big question, is there anything wrong with this? So as you say, right, the Ponzi scheme of the last generation was it leverage? Was it kind of asset inflation? From my perspective, I'm not really too sure Is that a bad thing or not? And that's the bit I don't understand.
No, because I just think about I think about zombies. It's that time of year to think about zombies anyway, for a start, right? But I think about the zombie company concept. And by the way, if we're talking about cheap money, just for those that wonder, well, what is this term, cheap money? We're talking about low interest rates, very low interest rates, unreasonably low interest rates. And that causes a distortion, doesn't it? Because it causes things to be alive that shouldn't be alive. It doesn't prioritize productivity. It almost prioritizes where you are in the production line of that cheap money, I guess. And so it doesn't necessarily allocate capital as efficiently as it should. And therefore, you don't see the creative destruction efficiencies of what happens in the free market. And so if you understand a little bit about how the raw free market works, you know that there's some good and there's some bad in that. And when you look out there and you see a lot of activity happening in startups, you see people maybe taking 6 months off to be with the kids, like nothing wrong with this, by the way. But when you see that quite often, when you peel back the layers, you actually realize that there's often debt. And I'm talking about the household level here. Often there's debt, and people are using the fact that their mortgage payments are quite low, or they were until interest rates increased. And that creates more of an abundance of new ideas, experimentations. And so some innovation and some good stuff can come out of it. But at the same time, I guess we can normalize, and we can our whole world can equalize around that cheap interest rate. And that's probably what's happened, right? Like, is that why we're feeling this uncomfortable pain right now, do you think? Is that we're trying to find the new normal?
Well, I think one of the things that, but I think I think the pain piece is kind of slightly, they are related, but they're also very different, right? The pain piece is because we're now sitting at inflation. And I think that's the thing, right? We're in a very high inflation world. And I'll be honest, I don't think we've really got to any closer at all to understanding that high inflation world and what's driven it. And so I think the big thing that no one is clear on is, is the inflation a result of this massive increase in money supply over the last 15 years? If the answer to that is yes, then we're in for some really scary times. Because fundamentally, then you've got to unwind this little super cycle. And that is not going to be easy at all. Or is it due to all of these other factors around raw materials, supply chain shocks, all of that other kind of stuff that we see at the moment? And I think, but I guess the question that I'm not sure on in my mind is, if we could control inflation, but keep this money printing machine going, is that a bad thing or a good thing? And I don't know the answer to that. The research, which is really interesting, is about actually the social impacts of this massively increased dispersion of wealth. And kind of, are people going to rise up and revolt at the fact that the top 2% own more than the bottom 60, 70%? And that's growing every single day. So I don't know. It's a really interesting one, right? But it's but it's hard. And I think that the bit that I kind of struggle with is, if the answer is that this free cheap money printing machine is what's caused this inflation, and this is a buildup of inflation over the past 30 years, then holy fuck, it is going to be really scary to figure out how we unwind this, because the medicine is not going to be pretty.
Yeah. Well, we're feeling it already at the household level with the mortgage interest rates that I'm seeing come across my desk, 3% more than what they were paying a year ago. It is an incredible shock. And if people haven't actually planned for this or anticipated it, I could only imagine just the level of pain that some households are under right now with the amount of debt they're under. And that's just a tiny glimpse of it. But what you see at the household level, presumably you're seeing at business levels as well. And so that whole thing probably takes time to move through the system.
Well, how about that, right? What about governments? What if governments actually have to balance their books, right? I mean, here's an interesting quote from BlackRock guys last week about what happened in the UK gilt market, where they kind of said, hold on a sec. They basically, the $45 billion of unfunded tax cuts, where the market went absolutely spastic over, 2 years ago, they did kind of £100 billion worth of unfunded stimulus for COVID, and no one seemed to care, and everyone was really happy about. And so I just find it absolutely fascinating that so the markets are starting to care. But if this is the new normal that we moved into, all of a sudden governments are going to need to start balancing their books. That means significantly higher taxes and probably simultaneously significantly lower public spending. I mean, that's going to be pretty ugly. We're going to have to start seeing corporate debt properly price in the impact of risk. The fact that at the moment there's kind of a 3 percentage point difference between a high yield junk bond and a kind of a very, very high graded AA corporate bond, the risk level shouldn't be supporting that. That's going to jump up to 5, 6, 7, 8% even. You're going to start to see those companies fail. And so you're going to end up in a world where consumers have higher interest rates, businesses have higher interest rates, governments have high interest rates. And I mean, that is really scary, right? I mean, the only analogy I can think of is, it's basically weaning us off this debt. It's going to be a little bit like a 20-year addict, heroin and pee addict, trying to get themselves off cold turkey all in one go. It's not going to be easy.
Yeah. And so I guess logically, so we're thinking about pulling back on government spending. There is higher interest rates that we all have to swallow. Our expectations have to probably normalize around that. Do you think it's going to happen? What do you think? Do you think that's actually possible?
Well, the argument that we have all been talking about for the better part of the last 10 years or 15 years is no, because the global economy can't handle it. And so that's basically been the standard answer whenever anyone is asked about will interest rates go back to kind of will ever interest rates ever rise, because fundamentally there is now way too much debt in the system for that to happen. And I think that's the gazillion-dollar question, right? That no one really knows the answer to. And this is kind of why I say you've got to bring it back to that inflation question. And if it is all of this free money that has created the inflation, which I think is probably the truth, a combination of that plus the labor stuff and the global population changes, then fundamentally, I think we're probably going to be in for some pretty ugly times, and central banks and governments are going to have to take the view as to what is worse, this deleveraging impact or inflation. There's already quite a lot of chat among the economic circles of, well, do we need to give up on 2% inflation target? Do we actually need to go to 4% inflation target? Because fundamentally, the interest rates that 2% mean are never going to happen, are going to be way too high, and the damage that it does is going to be there. So I don't know. I kind of 6 months ago, I would have said, hold on a sec, let's just let this party continue. Don't worry, the interest rates will kill any inflation pretty quickly, as well as the broader economy. But we're not seeing that. And so potentially we're going to need to see something a whole lot stronger than where we are today.
Yeah. And you mentioned central banks in terms of, well, demand, supply. We know that supply has been really boosted. Supply has really been constricted with what's going on in the world, starting with COVID, currently in war. Demand, loading the weapon of consumption by creating more currency and lowering the cost of money. That came first. I think we really need to remember that, right? Like we need to remember that the order of things here, so that we don't believe that actually it's on the supply side that's causing the inflation. Yes, that's true to an extent now, but let's remember what happened first. Quantitative easing, artificially low interest rates. And it speaks to I got to be careful not to go into the weeds here, right? Which I never do with you, Rupert, by the way, do I? But it kind of just speaks to this bigger bogeyman, this nastier zombie that central banks seem to have consistently proven that they're afraid of, which is deflation. And I know it might sound really controversial, not a conspiracy theory, hopefully, but it sounds really odd for me to suggest this, but it is quite possible that deflation could actually still be the end outcome here if things don't go according to plan. Do you know where I'm going with that?
No, not really.
Okay, well, I'll make it up then, and no one will ever know. So I'm kind of just thinking, if it's clear that the economic system hasn't been creating inflation on its own, then in a sense, the central banks around the world could have actually allowed this to go on for a little bit longer, which is kind of what I think happened. You know where I'm going with that?
The natural state was actually deflation, but we've artificially created this. So therefore, and so I think it's a really great question. Actually, was that something that we should not have been so scared of and maybe kind of let through? I mean, the flip side to that is, yeah, but the problem, the biggest issue that you have in a highly leveraged world is security of assets, right? And security sitting over all the debt. And that is also why I kind of go, fundamentally, the only way out of this situation that we're currently in of deleveraging is actually inflation. And so, because you can't pay the big debt back, let's be honest, no one's ever going to get enough money together to pay all the debt back. So the only way you can do it is to kind of inflate your way through it.
Yeah, that's one way, and that's kind of what we've been doing to a certain extent. But
yeah.
Either there's like a Jubilee event where there's debt forgiveness, or there's a foreclosure event, right? Like what would happen if you couldn't pay your mortgage? Somebody takes it away from you. And I don't even know how to start imagining what that would look like. But if nobody could afford to service their debts, then that debt is owed to somebody, and they're going to be looking for the collateral, even if it's not enough to cover the debt. I don't know where that goes. Do you have any comment on that one?
But that is why it doesn't go there. So, and that's kind of where you kind of end up in a world where you potentially end up in a medium-term cycle of schizophrenia of 1 minute inflation is important, so therefore we're going to go after the interest rate. We're raising interest rates. Hold on a sec, we've done too much damage because we're starting to see asset prices fall. We start to see exactly the things that you're going to go. Everyone's going to get scared. It's easy to see a world of schizophrenia where people are going, what's worse, inflation versus deleveraging versus asset price deflation, and how do we kind of deal with those three things and the various impacts? But yeah, that's kind of a little bit of, I mean, it's pretty easy to see that world going between those three things.
Yeah. And so where to from here then, right? Because I kind of get the feeling that as long as we can kind of maintain the status quo to a certain degree, maybe that's probably the best middle lane to follow, right? What are your thoughts on that?
I 100% agree. I mean, I think with the cost of kind of diverging and unwinding this Ponzi scheme, the boomer Ponzi scheme is going to be way too high for the broader population. But in saying that, running permanent 8% inflation is also going to wipe people out and cause a huge amount of pain and suffering. And so, personal view, inflation is probably here for higher and longer than people are suggesting. I think the central banks are probably going to keep on fighting. We're probably going to still be having the similar conversation into the middle of next year at the very earliest. But there is at some point, the central banks are going to go, cool, we've probably done too much damage and we're going to have to back off. And it's going to turn into a really interesting question, right? Growth versus inflation, the fight against inflation, how much damage does that do? I think I'd be amazed if central banks hold their nerve for as long as they probably are going to need to.
Well, they're playing a pretty convincing game of chicken right now, if that's what they're doing. And I just, like, I wonder with what you were saying before, Rupert, around maybe we're going to just have to live with inflation for longer and just get used to it. I wonder then, well, in terms of our real rates of return for our investment, so that's the rate of return that we get for our investments after we subtract the inflation rate. If we're, say, averaging 8%, then we're going to need to get more than 8% rate of return on our investments, which at the moment is pretty hard to see when almost everything is red, everything is going down. But just like I guess, risk and return are related, but they don't necessarily happen at the same time like what we imagine. We might get the return before the risk or the risk before the return. So what we're kind of maybe going to see is we're going to see either sharp returns later on, or maybe the returns that we got in the last 2 years is compensation for the pain that we're going through right now. What are your thoughts?
I 100% agree. I mean, that fundamentally, the only way that you get the return up is drop the asset value. Two ways of getting the return up: you drop the asset value or increase earnings, and that's what we'll need to see. We are going to move into a high cost of capital world, and yeah, so that is the pain, and that's the transition that we're currently going through. And how high that cost of capital gets will determine how much pain we need to go through. So that'll kind of determine the cost of capital argument. And then the second big piece will be, and how much pain we go through in terms of interest rates will probably drive the earnings number as well. So yeah, I don't want to be too skeptical, too pessimistic, but it's pretty hard to see us kind of this world coming out of it. The bright spot though, what we are seeing in markets at the moment is they are looking for any tiny excuse they can find to move up. And we've seen it over the last couple of days where we kind of had Friday, a pretty bad inflation number, followed by a great day in the markets. We've seen that over the last couple of days as well. We've had 3 out of 4 up days at the moment, off no real news. But if anything, most people were expecting it to go the other way. So it does show, right, that even though the technicals are telling us one thing, the markets have still got a huge amount of buoyancy and money sitting in behind them, which are just looking for an excuse and a way to go up.
I know. That's probably, and there's probably another half an hour to discuss that, right? I think anyway.
You can explain to me what happened on Friday last week. Oh, that would be amazing.
Yeah. Okay. We need to have a chat more about that one. So, all right. Well, that's the end of our time today, though. But as you can see, there's no shortage of material for us to chew on. So maybe we can keep the conversation going next week. Now, for our listeners, for the people that are listening, watching, keep the 24th of November free and clear in your diary. It's in my diary. It's in Rupert's diary as well, even though his face looks confused right now, because we're having an event on the 24th of November. We will do an announcement on Monday's podcast. So make sure that you're subscribed, listening into the Monday episode of the NZ Everyday Investor, and all will be revealed. So, Rupert, thank you very much for your time here, and we'll catch up with you again next week, eh?
Awesome. Well, thanks, Darcy, and we'll speak next week.
All right. Cheers.